Hello traders, it's Wednesday, January the 29th. This is John Kicklighter, Chief Strategist for dailyfx.com. I'm here to give you your FX market wrap-up for the past 24 hours of trading and an outlook for what we can expect in a very fundamentally important next 24 hours ahead. I only need two charts to encompass the kind of conditions that we are facing. Congestion heading into some major event risk and the possibility of very significant breakouts and potentially a upgrade to trend generation. Those are the kind of conditions we are looking at with the FX and broader capital markets right now, and that's the kind of approach we should be taking towards our trade setups. So the first chart I want to look at really gets into the meat of what the fundamental docket has to offer. That is the FOMC rate decision. All right. Now, seeing the docket, you can see this comes out at 1900 GMT. Be very aware of the release of this data. This has very influential components to both the US dollar and interest rate expectations, as well as general risk trends. All right? And the dollar has both of those standings as well, so this is perhaps one of the most appropriate charts for the importance of that fundamental event risk. Now you can see here on the daily, or not daily, 8-hour chart for the dollar index, the the Dow Jones FXCM dollar index, that we are in quite a technical bind. I like to see this. This is a good thing, because when we have technical bearings such as this, where we have an essential break, a must-break scenario, and it's a must-break simply because we have no more room to run, but you have a break nonetheless. That gives you the technical impetus for pressure, the catalyst that can turn into a breakout, the breakout that can turn into a potential trend generation with the right instigation. But we need that trigger. All right, and we have to be able to play the event risk that we have coming up in the appropriate manner. Before I get into that, I also want to point out the S&P 500, my other benchmark consideration. We know what the big trend is here, long-term bull. All right, but I also want to point out that we've had a significant correction through the past week. A lot of this has to do with emerging markets and the implications that has for negative sentiment, or at least risk aversion. And the pullback we've had from the S&P 500 is gotten a lot of people on edge. A lot of traders are 1 foot out the door, ready to head for the exits if need be, but are we going to get there? And before we give ourselves over to the risk aversion outcome of a possible taper tomorrow, I do want to remind you that from a technical perspective, this is a very long-term resistance that we are now treating as new support. Now, you can see the confluence here. There's actually a lot of technical levels all lining up at around the same level, 1775. This is a big rally that we had here from the October low to the record highs. That puts a 38.2 fib. We have the 200-day moving average, which you can see here in the green. All right, and we have a collection of a couple trend lines actually that all fall into that precise point. That is a very strong technical bearing, but more importantly, the fundamental bearing is simply that we have a level of complacency and consistency in this trend that is very tough to turn these markets around. Whether bullish or bearish, whether we're talking about a considerate level of fear or risk appetite based by moral hazard. Once we have that consistent trend, it is more difficult to turn the market than it is to keep it going. So, when we head into the upcoming event risk, we are going to look at these two benchmarks with the view of how they are leaning, how the technicals and how the fundamentals are leaning into its release. Now, I spent the entire strategy video specifically dedicated to the possibilities or scenarios for the upcoming taper that we are expecting from the central bank. And you can see all the details there. I will just briefly discuss it in today's trading video, but I generally see 3 outcomes for this event risk. All right, and the outcomes are more about what the possibilities encompass. But we have the FOMC potentially holding QE at 75 billion. That is a low probability according to markets. I measure through swaps according to economist estimates, which I got from Bloomberg, and my own assumptions on how the central bank has positioned itself, the commentary that the individual members have given, and the general shape of data and the commitment that they have to do. Because remember, they are, above all, game theory players that have to be able to promote market stability as well as remove all the surprise from events like this. All right, so a $75 billion taper, or in other words, a $75 billion per month movement would be no taper. I think it's a low probability. I think an even lower probability is that they taper by 15 billion or 5 billion. When we're looking for a very clear signal, when we want to remove all the vagaries out of monetary policy so the markets can adjust to what we plan on doing as central bankers, we want to make sure that we follow a consistent pattern. Risk managers are able to adjust for a steady $10 billion taper per meeting. All right, they're not going to be very good at adjusting for the risks of a 5 billion and then a 15 billion and then a 10 billion taper. All right, that becomes more ambiguous, and uncertainty leads to volatility, and volatility is exactly what the Fed is looking to avoid. Now, I said this in the Q&A that we held this past session in Daily FX Plus. Market, when you're talking about the markets, the central bank, the Fed, is not looking necessarily to keep the S&P 500 propped up. That is not going to be their objective. Their objective is to keep the volatility, the fear, the risk, and the market dislocation that comes with an unwinding of excessive risk positions from infecting the entire system. If the S&P 500 entered a bear trend, right, but it was doing so in a slow and consistent manner, the Federal Reserve would likely leave that bear trend untouched and allow it to clean through some of the excessive leverage and the buoyancy that they have helped create. Because when we look at the market conditions that have supported this epic rise to record highs, we know that there is more than a fair share of leverage. Actually, there's a record amount of leverage that has supported this move. At the same time that we have seen participation fade. Right, volume figures, as you see here, mapped against the volatility level. And that's something that is seen as a unsustainable situation. You want to have consistent and rising participation. You want to have low leverage, as high leverage and low cash balances to cover margin calls would indicate that any kind of meaningful break lower is going to amplify losses and encourage people to abandon markets more aggressively than they would otherwise. So when we head into this, we got to think in the mindset of a central banker. But at the same time, we have to also approach it and trade it as a trader. The most probable outcome here is a 10 billion taper to continue with the trend that they began in December. All right, and the impact that would have, many people think that, hey, this is already priced in. This is a high probability outcome, as you can see across all three measurements. But I still think that it has a market moving impact. All right, for the dollar, it is ultimately bullish, and for the S&P 500, my measure of risk trends, it would be bearish. The question is how momentous would it be? What level of impact in terms of follow-through would we be able to generate through that kind of market movement? All right, that's the question. That's the question we're put up against. Now, in those terms, I do think that this still has a very good potential for feeding markets, market movement, market volatility, because we have greater concerns that the markets have been able to tap into. Now, we have been following the high level of volatility that has evolved through the risk severity curve. This was the subject of an earlier strategy video, but we have escalations here. All right. Low volatility, or few volatility events, low correlation. We are obviously very much past that. Frequent volatility events, or a volatility event on one of the major markets, and rising correlation. We've already passed that. A concerted unwinding of riskier assets with moderate correlation. We've definitely gotten there. We haven't got up to the full unwinding of all risk assets, but we definitely have gotten past this level. So we are in the midpoint of this risk aversion curve and its market impact. And a lot of it has been sourced from the emerging markets. This morning's emerging market news has been very substantial. In fact, the past 24 hours have been very substantial. We had the Reserve Bank of India hike rates. We had the Turkish Central Bank hike rates quite substantially by 4.25%. All right, that's 425 basis points. That's quite substantial as well. And then we also had Argentina, the Argentinian peso, which was arguably the leader of all of the emerging market volatility that has been covered in the media. We end up having some stability here, though it's not necessarily coming back down after a forcible curbs put on outflows of capital from the country. So they are making moves to stabilize this situation, but does this necessarily mean that we are going to have a risk-free view ahead? Not likely. This has put the market on edge. All right, we certainly see emerging markets are going to focus traders' concepts of risk, and we will see if it moves up the scale. The S&P 500 is obviously one of the asset classes or asset benchmarks higher up the scale, but we are also going to be looking through emerging markets, the capital markets, and then also funding markets. Funding markets being the most critical to measuring full-scale risk. Can we get to the funding markets through this kind of event risk? It's going to be very difficult to do, but you can still influence risk trends. All right. Lower down the scale. If I want to see the sensitivity of risk trends to to a continuation of taper, then my first visit is going to be emerging markets. If we put asset classes on this risk aversion curve, the emerging markets and high yield corporate bonds or junk bonds would be at the very end. They're most sensitive. All right, they don't need much of a change in monetary policy to impact those asset classes. Higher up, I would say the yen crosses. Higher than that, I start to look at the equity indexes, and then we get into dollar, then we get into euro dollar, the most liquid of assets, and up here we get full-scale treasury demand. So the emerging markets are going to be the first thing that I look at. The second thing is going to be the yen crosses. All right, that's going to be my first step up from the risk scale. Then I will look at the S&P 500. Automatically, if I see the S&P 500 moving aggressively one way or the other, I have a nice benchmark, a midpoint benchmark, to see how the risk theme is playing out. But if you do see that the S&P 500 is relatively reserved, as would be the Nikkei 225 futures, which have bounced off their own critical support, the same with the FTSE 100, all right? Noteworthy support as well. If all of these indexes play out the same and they continue with a moderate level of advance or decline, it doesn't necessarily mean that risk is essentially going to ignore the data or ignore the event risk. We could still see a buildup of pressure lower down the curve. Once again, emerging markets and the yen crosses. So what does this mean in terms of my trading approach into this very significant piece of event risk? Well, I talked about my trade setup preferences in the strategy video, so I recommend you go see that. But my favorites for the outcomes of the various responses from the market, if we have risk positive drift, all right, if we have the S&P 500 drift higher, I find it highly likely that the dollar would really drop off aggressively, although it can definitely break to the downside. But follow-through would be very difficult to sustain. And seeing the equity markets really rally aggressively is very difficult to muster. All right, so I have to choose my risk-on, quote-unquote, setups a little bit more frugally. Dollar yen, as I said before, is one that can play well because if risk trends are steady, we know what the backdrop for the Japanese yen looks like. The expectations of more stimulus from the Bank of Japan, although that recently has been put into question. We also have the US dollar likely still continuing with the taper trend, and that would also support the US dollar. All right, so dollar yen to the upside actually plays out very nicely for a positive dollar, yet at the same time stable or moderately bullish risk outlook. So this is actually a double duty kind of currency pair. Now, what about an outright risk on drive that also hurts the US dollar? If the taper decision doesn't come on the off chance that that is indeed the case, what currency pairs look good? Well, if that's the case, I want to find the dollar where it is out of its element when we're talking about relative monetary policy. That would be the pound dollar, seeing it rally above this previous peak over here late last week, above 166.65. That would be a good continuation opportunity. All right. If we also want to pit the U.S. dollar against something that we consider to be a oversold currency with a greater yield expectation, Aussie dollar. If we can break above this previous swing high here and start progressing for the Australian dollar's benefit, that would be a great setup. Right. I'm waiting for the Aussie dollar to eventually regain its own footing when it comes to interest rate expectations. That is proving very difficult to seep into the market, but certainly a dollar sell-off on risk-positive sentiment would help that case here for the Aussie dollar. Now, more than likely, we're going to get something that is the taper, a $10 billion taper. The question, obviously, is how aggressively the risk responds. If risk aversion really does not kick in, we have to be, once again, more picky or more choosy with our trade setups. If that's the case, I will be looking to see pairs like the pound dollar, all right, as we still see the taper and interest rate expectations are going to play through more clearly here. This is not necessarily a risk-based currency pair. This is much more about the Bank of England interest rate expectations versus the Fed Reserve's interest rate expectations. And if you recall, this past session, we had the UK GDP figures in line with expectations. It was actually on the year, one of the best year that we've actually had for the UK economy since I believe 2007. So it is a pretty decent recovery. It's a pretty strong recovery compared to many of its counterparts. All right, but does that necessarily sustain interest rate expectations that have really been ramped up higher? Does it sustain interest rate expectations versus a taper that is going to bring forward the possibility of Fed rate hikes? All right, that's the question. And we can definitely just wait. I don't want to just go on fundamentals alone. I want to go on technical breaks as well. So I'll be watching around 163.50 and then obviously down here 162.50. Perhaps my preferred trade, however, is the Euro USD. This past session we had the ECB once again failed to sterilize all of the government bonds that it's holding from its bailout efforts. And this is a sign, along with a couple other indicators, that the financial system in the Eurozone is actually seeing the ill effect of a rise in short-term lending rates. That wouldn't necessarily seem very bad if it weren't for the fact that the Eurozone is still a two-speed economy. We have recessions, we have record high unemployment rates in certain countries, we have easily exacerbated, easily upset financial uncertainties in the region, like the Spanish banking sector, which, as it happens, in the upcoming session, we are going to have the European Commission release its fifth and final Spanish bank review. All right. So a lot of uncertainty in the Eurozone. We just need something that pushes and catalyzes the situation over the edge. The euro is an exposed currency, in my opinion, especially after all those capital inflows into the Eurozone or into European debt from Japanese investors, something that we've been tracking a little bit here. But that capital inflow is certainly, and you can see it a little bit better in shorter term yields, 2-year yields for Spain and Italy. That is record low borrowing costs for countries that have the largest debt in the Eurozone and which also have the very unstable economic situation. That does not seem to compute. All right, that's because there is the same kind of circumstances we are seeing in the capital benchmarks. There's a lot of leverage, a lot of speculative appetite for yield. These are as much as exposed to volatility as anything else. more so than your traditional capital market benchmarks. All right, so we get volatility that undermines the euro, and the euro dollar drops. If the dollar simply rises because of taper confidence, the euro dollar drops. All right, so this has good prospects under most circumstances. Now, I'm already short here. It does look good, though, if it does have continuation or fine continuation below 136.50 and 136.30, as you can see these relative levels here. Now, if things really start to get going and risk aversion kicks in, I'm going to be watching for 135. And I can definitely build up into this position as long as the fundamental considerations and the market conditions for trend generation support that move. All right. These are some of the pairs that do look good if we're talking about steady market conditions. We can also look at the full-scale risk aversion. But full-scale risk aversion, I do want to see it climb up the scale. I want to see the S&P 500, the emerging markets. I also want to see some of the more stalwart, slow-to-move currencies and capital market benchmarks move alongside them. All right, but in full-scale risk aversion, we can pick pretty much most pairs. Euro dollar, Aussie dollar, although this one isn't as well positioned, pound dollar will even respond to risk aversion, and of course all the yen crosses. Dollar yen is not my preferred for risk aversion. My preferred, as I've said time and again, is the euro yen. I need full risk aversion, but this is my preferred risk aversion pair. The higher yielding or carry trade yen crosses are also very well positioned for that kind of circumstance. The Aussie yen has pulled right back up to its former support, now new resistance if it potentially has risk aversion. Kiwi yen and CAD yen, similar situations. All right, they can play out very nicely as well. Now, if we want to fall outside of the boundaries of pure risk and focus on the taper, it'll be very difficult to get away from both of those themes, but we can also look for some other potential setups, especially if the market outcome of these events are relatively steady. All right. Another rate decision I want you to focus in on is the RBNZ rate decision. Now, this one is particularly important because compared to the Bank of England, who the market is speculating that they can move in 2014 rather than 2015, as they've suggested, where we're starting to talk about the FOMC taper, where the Bank of Japan has kind of quieted its conversation about need for more open-ended stimulus, and the ECB is on the fence of whether to offer up more LTRO-like loans. All right, the RBNZ is not confused. It is talking about rate hikes. Governor Wheeler last month actually said that he expects the benchmark lending rate in New Zealand to be some 225 basis points or 2.25% higher than where it is now. It's nearly doubling the interest rate by 2016, the first quarter. That's a huge move. I mean, that's more aggressive than any of its counterparts. But how has the Kiwi dollar performed since that forecast was given? Up against half, down against the other half. Right? Market is not pricing in very much of this. So we can take a very close look at the risk sensitive of these Kiwi crosses, the Kiwi yen and the Kiwi dollar, which is very confused. But we can also see how this plays out against the more yield forecast sensitive currency pairs like the Aussie Kiwi, which is my and a couple of my colleagues' favorite trade setup here, just off of multi-decade range lows. The Kiwi CAD, which I haven't really covered all that much, but we can also keep a very close eye on some of the more preferential pairs that are Kiwi-based. Euro Kiwi, we know the euro is a very troubled currency from a fundamental perspective. It just needs some impetus to turn it over. I'm really interested in the pound Kiwi. We have a triple top, right? We have a rising wedge formation, and we have a much bigger reversal pattern down here. All right, this is technical pattern within technical pattern within technical pattern. It has great potential. It just needs a little push to get it moving. So there's a lot of event risk up ahead. Two major themes that we must keep in mind: risk trends and the health of the dollar as the taper speculation starts to play through. We need to see whether this is the kind of catalyst that can not just alter the dollar and U.S. interest rate outlook, We want to see if it can actually influence sentiment across the board. If it can, if it gets to that level, the trading opportunities are far more significant. You have a greater breadth of opportunity. But even if we don't get to that full-scale risk aversion, cater to the volatility that we've seen from the emerging markets recently, we can also still play this as a very straightforward fundamental theme. All right, we just have to have the proper approach, and we have to have our strategy ahead of time. All right. I will be covering this event risk live, the FOMC rate decision, back in Daily FX Plus. I will be beginning 15 minutes before the actual data or actual announcement is given, so we can strategize ahead of time and we can prepare you ahead of time. Come by, join me. If you want to learn more about my views on the FOMC decision and the opportunities therein, you can also check out the strategy video. So until tomorrow, good luck trading out there, guys, and be very safe.